Hey guys, this is Justin. Welcome to the Excess Returns Investing channel, where we focus on the strategies and tactics that can help you become a better long-term investor. If you're interested in learning about investing, please join us as we learn along with you. Thanks for checking us out. There's probably no topic more on investors' mind over the past year than inflation. In this episode, we dig into the details of constructing a portfolio to help combat inflation with Dave Schlachler of VanEck. We discuss why inflation might be with us longer than many people think, the assets that help best protect against inflation, and how to combine those assets into an inflation-fighting portfolio. We hope you enjoy the episode. Just one more thing before we start. For anyone who is new to our channel, I want to thank you for coming and invite you to join the Excess Returns community. Our goal is to build a community of people who want to work together to become better long-term investors. And thanks to the support of our viewers, we have more than doubled our subscribers on YouTube in each of the past 2 years. We want to do it again this year, so if you find our content valuable, we hope you will join us and subscribe to our channel and like this video to help us continue to grow this community and reach our goal. We appreciate your support. Hi, Dave. Thank you for joining us today.
Thank you so much for having us.
We're going to talk about investing, inflation, the markets, the various ETF and strategies that you're responsible for at VanEck. But I wanted to start with you about something that I noticed in your background. And that was before you joined VanEck, you were actually in manager selection. So you were responsible for looking at and selecting managers, which I always think is a very sort of interesting job, because you probably got to see a lot of different firms, a lot of different investment strategies, and kind of sort of probably helped you like really grow as an investor over time. But I wanted to sort of ask you, what would you say if you could kind of boil down to some of the most important criteria in selecting a manager? What would that be?
And you're the first person to ask me this. So I think that due diligence, if someone's about to get involved in our industry and they want to figure out what's the best way to learn it, I couldn't imagine a better breeding ground than due diligence. You'll literally get to go out there and speak with the smartest, most successful people with proven track records on a daily basis and figure out what's worked for you. And then you go to the next person, you figure out what's worked for them. And then certain people are going to speak to you more clearly than others, right? Certain people are going to connect with you more than others. And you can take tidbits from each person and help kind of build, right, your overall philosophy and then apply it to a process. So I think of my previous probably 10 years plus doing that as a gift. And I was really lucky, and I didn't realize at the time, but it ended up turning into such a great thing because it really impacted me in a huge, huge way. Now, what's the biggest thing that I think to look for when you're looking at a manager? This is a really simple answer, but I think it's the most important. A long-term track record of success, right? Consistent outperformance. When you start to think about that, really, what is it telling you? It's telling you that you've got an investment manager with a sound investment philosophy and a strong investment process. So the really short and simple answer to that is look at somebody who's had consistent, and I'm going to emphasize that word again, consistent outperformance over a long time. That is the biggest telltale sign of a manager that's likely to perform in the future. Don't get sucked into marketing gimmick and a great story and sensationalism. The reality is that person that's generated consistent, I'm going to say consistent again, I keep saying it because the hot dot doesn't work. The guy or gal that's generated a ton of outperformance, all to lose it all in the next cycle, that's not the one you want to bet on. You want to bet on the person that consistently generates that alpha because they've figured out an approach that works, right? An identifiable advantage that they've been able to percolate and take advantage of over time.
How did you take that experience and then ultimately end up in the role that you're in today, which is the head of quantitative investing?
Yes. When you speak with different portfolio managers, you will often hear of the art of portfolio management and the science of portfolio management. I look around the industry, I don't see a lot of artists. I see people that have found clear identifiable advantages that they're exploiting on a consistent basis by taking measured bets. That's what I see. That's what speaks to me. So when your brain is built that way, I want to be able to prove everything, right? I want to go back over time and see what actually did work and why. What can I prove? What is actually a repeatable source of alpha that I can see and then try and reproduce? And that's what lent me towards quantitative investing. Think about quantitative investing as this. You're really a market historian. You're looking at history through a quantitative lens. Once you understand history, you could better understand today. You could start to think about tomorrow. And that's really what spoke to me when we think about quantitative investing.
Before I hand it to Jack and he asks you some strategy specific questions, I wanted just to get your perspective. You've been at VanEck for over 10 years now. And so clearly you've had a seat to how a successful ETF issuer grows over time. I mean, the ETF business is tough. Obviously, it's lower fee than mutual funds. It's super competitive. It's mostly dominated by, a handful of firms, but then there's firms like VanEck that have been able to stand out and actually build great businesses. So if you could kind of pinpoint from your perspective, the keys to success and survivability and making it through, what would that be?
I'll simplify it down to 4. The first is clearly communicate an advantage. The second, deliver on that. Your performance should match the expectations, not under promising, right? Delivering on what it is that you set out to do. The second, staying power. You can be very right, but very unlucky, meaning that you could launch a strategy that's doing all the right things, but the markets go against you and you have extraordinary event one after another. Then you need the staying power to actually stick it out. And then the last part, really when it comes down to point 4, when it comes down to ETF specifically, you should have a cool ticker that clearly communicates the strategy and it sticks. Sticks meaning if I tell it to you once, in your mind, you should remember it, right? If you walk away 30 seconds later and you're like, hold on a second, what was the ticker for that? You've lost at that point. And I'll give you a really quick example. We have an ETF called the ticker's MOAT, M-O-A-T. This was launched in 2012 and it hits on all 4 of those and it's been a phenomenal success. The first is clearly communicated expectations. So outperform over the long run with Warren Buffett style investing. Delivered on that, it's generated strong, consistent, I'll keep saying that word, consistent outperformance. We had staying power. The fund launched in 2012. It took around, it was about 2017 before we hit $1 billion. Now it's around $7 billion under management. So staying power, sticking with it. And I'll go back to that ticker. It's a cool ticker, MOAT, directly matches what we communicated, right? So that's the way that I think about it if I could simplify it down to 4 points.
Yeah, that last one has always surprised me, but you hear from a lot of people that have successful ETFs is like that ticker is really, really important. Like if it communicates, trying to communicate in 4 letters exactly what something does is really hard, but when you get it right, like it's a home run.
We just launched, 2 products that I manage. We just launched a ticker for a commodity fund. The ticker's PIT, P-I-T. That's a throwback to the old commodity pits. So some people loved it, some people didn't, but everybody remembered it. And the people that are into commodities understand it. So that I think will prove to be another winning ETF as long as we deliver on the performance that we expect.
And looking at your strategy, one of the things I noticed is, you mentioned being a quantitative investor before, but you're also blending that with like a discretionary, more standard portfolio process. And I'm wondering, whenever I talk to people who have that quantitative background, I like to ask about the balance between the two. Like, what do you think quantitative strategies do well? And what do you think discretionary strategies do well? And how do you think about bringing them together?
That's an awesome question. You guys have a lot of good questions. So quantitative managers have a lot of advantages because they can remove themselves from the emotional pitfalls that a lot of discretionary managers have. It's very hard to stick with something when everything else is telling you that's wrong, right? So when the market's telling you you're wrong, to stick through it and be the one person doing something that everybody's not, that's a very difficult thing that people have a hard time with, even professional investors. That's a very strong advantage to a quant. The problem with a lot of quants is being too dogmatic, following the signals, not realizing that, sometimes this time is different, right? And I think the blend of a quantitative style with a fundamental discipline really gives quantitative style investing a real gut check. That's the way I would describe it, where you're combining all of the informational advantages and the behavioral advantages you get from the quant side with the common sense and experience you get from the fundamental side. And when you merge those together, we think there's a lot of power in that. And that is my favorite style of investing when you bring those together, because I appreciate all types of strategies as long as it works, right? Fundamental strategies, quantitative strategies. I think there's value add in all these things. I'm not in one box. I look at these different styles, probably because of my background due diligence, say, That's something cool. That's something that works. And everybody paints the canvas differently. And if they're doing it well, it's going to show up in their performance. And there's something that you can learn from it.
Yeah, to your point about things changing over time, like I think that's really important in quantitative investing. And like a lot of times, we're quant investors, and a lot of times when we talk to people, they'll say, well, I love quant investing because there's no human decision making. And that's true a lot of the time, but it's not really true because ultimately a human is making the strategy, a human deciding when to change the strategy. So you're not going to get away from, there's some human discretion in all of this, and there's really no way to get away from that.
That's exactly right. That's exactly right. The quant that sat down to build some type of quantitative process started with a blank slate. They built the model or whatever it is that they're building off of based off underlying assumptions that were fed from the human being. So you can't get away from that. You're entirely right.
I want to shift gears and talk about inflation. We're obviously experiencing inflation for the first time in many of our investing careers, or at least high levels of it. And I just want to maybe from the start say, can you just give us sort of your overall view on inflation, like where we are in the cycle, what you see going forward, like what sort of context can you put the current inflation in?
We've been warning about inflation for a very long time now. So the CPI was sitting at 0.8, and we were telling people that we think we're going to get a lot of inflation. Unfortunately, we were right. And the reason being is because there was just so much dollars, so much liquidity was pumped into the system. We thought it was highly inflationary. Now, as we sit here today, a lot's changed. People have come to terms with that, but the narrative has evolved very slowly, right? At first it was, we weren't going to get inflation. And then we were going to get inflation, but it was only going to be a little bit. And then inflation became extreme, but nothing to worry about. It's going to go away tomorrow. And that has kind of continued to morph down to where we are right now, which is inflation's bad. I get it, but don't worry about it. There's nothing to do because the government's going to fix that problem for us. And generally speaking, that's where we are right now. Unfortunately, history would go against that. History would tell us that once high inflation materializes, as it is right now, it takes a very long time to resolve. If you go back, we've done studies, you can look at from the 1960s through recent periods and look at G10 countries. Once inflation breaks above 5%, it typically takes on average 18 years for it to fall back down to 2%. The last major inflationary cycles we had in the US were 1940s, 1970s. Both of those took well above a decade, and the average level of inflation was around 5%, with several peaks and troughs throughout. So the base case scenario should be from here that we're going to be stuck with high inflation for an extended period of time, because once that inflation genie is fully outside of the bottle, history tells us it's very hard to put back in.
And do you think we're going to experience high inflation from the perspective like it's going to go back to 8%, or do you think it's going to be one of those things where it's sitting at 4 or 5 and it's going to be really, really hard for them to get it down from that?
Peaks and troughs. Inflation comes in waves. So again, 1940s, 1970s, they bear out in very similar ways. Different reasons, different drivers, right? History is never exactly the same, but if you look at it, you can learn a lot from it. So bursts of inflation, pocket of disinflation, potentially even deflation like we saw in the 1940s, Fed relents, inflationary forces come back. And that we think that that's the base case scenario. If we had to put an average on it, because we think that that's the key. It's not necessarily has inflation peaked out. It probably has. Maybe not, but it probably has. It's the average level of inflation that you have for an extended period of time. And unfortunately, we don't think we're in a strong position to fight inflation for a lot of different reasons.
What would those reasons be?
So Powell is doing his best to channel his inner Volcker. That's what he's trying to do. But draw the comparisons between Jay Powell today and Paul Volcker when he started truly fighting inflation at the tail end of the 1970s, early 1980s. The first difference is the commodities. Those surges in oil prices that we had in the 1970s, we had fallen commodity prices when Volcker started fighting inflation. So those commodity shortages, those were resolved. Because of our underinvestment in traditional energy and the shortages that we have across the commodity complex, we think that we're going to have an elevated period of commodities that are going to flow into inflation. The second reason is war versus peacetime. Volcker had peacetime, right? We have an extended battle going on right now between Russia and Ukraine and their powerful allies on both sides that we think are going to put upward pressure on commodity prices. That's another huge differentiation. The other parts are that people were sick and tired of inflation by the time Volcker got into office, and they were prepared to do whatever was necessary to fight inflation because they understood that high inflation will have a dramatically bad impact on everybody if it continues. So everybody was ready for the fight. We don't have the political willpower for the fight. So if people think that Powell's going to be able to stand up and say, you know what, we're going to continue to slam down on the economy. We're going to engineer a wildly bad recession, and we're just going to keep rates high regardless of economic activity and regardless of how many people lose their jobs. They don't live in the same country that I live. And that's really the way that we see it. And we think, unfortunately, we're going to be in this situation where high inflation, the inflationary pressures, are going to outlast the Fed's ability, because we have so much debt, to continue to mount such an aggressive campaign against inflation. And inevitably, what happens is the Fed will pivot a bit. We will deal with a period of tolerable but higher inflation. We can deal with inflation of 4 to 5%. We can deal with that. We can't deal with inflation of 8% plus because that's so disruptive, but we can deal with elevated inflation. And if that's the case, that totally changes the game plan of what you would need to invest in to be successful in the period going forward. And it probably looks a lot different than it did during that disinflationary, low interest rate regime that we were in for such a long period of time.
Yeah, to your point about, talking about commodities and talking about the lack of the war and stuff, I think that's an important point. It's a point some other guests in the podcast have made is, it's not just the Fed here. Like, the conditions have to be right for the Fed to be able to bring inflation down. There's a lot of other factors out there. And, maybe Volcker also was in a situation where the conditions were right for him to bring inflation down. It wasn't just him solely bringing inflation down on his own.
That's exactly right.
So moving forward to like the types of things to invest in, that's the question investors always have is, all right, I want to fight inflation, but there's so many different things I can buy. I could buy commodities, I could buy gold, I could buy certain types of stocks, real estate. Like, can you just talk about the options available for investors and sort of how you view them in an inflationary environment?
Yes. So we've studied this ad nauseum. We've written a paper on this, and it's just something that we've spent so much time on. Once we really thought about the inflationary regime, we became probably unhealthily focused on how do you invest during this regime. And our conclusions are simple. The first is you want to invest in resource assets predominantly. So we're talking about commodities. Commodities respond immediately to supply-demand imbalances. We think because of the commodity shortages from our transition away too quickly from traditional energy towards renewables, which required tons of minerals and metals to facilitate, we're going to have structural shortages, especially in the commodity complex, for an extended period of time. We don't see a reasonable way out of that. So commodities elevated for an extended period of time. On top of that, and we think what would actually outperform that is natural resource equities, companies that benefit from higher commodity prices. So think of oil services companies, anybody that's involved with extracting, producing, distributing commodities, natural resource equities, because they have operating leverage. And they've shown so far, especially on the oil side, to be very disciplined when it comes to capital allocation. That's the first segment, and we think that that's one of the biggest. The second, financial assets. We're talking about gold bullion and gold equities. A lot of people have been super dismissive about gold, and they don't think that gold's going to be that store of value asset. We have a very different take on that. This is the way that we think about gold. Gold doesn't have the utility of other commodities. So for gold to work, people have to seek it out as a store of value asset. If you don't have a problem to solve, there's no reason to seek it out. Meaning, if we were never going to get inflation, and then once we got it, it was going to go away on its own. And then if it's not going to go away on its own, the government's going to do it for us. So these are all self-correcting problems that don't have to be addressed because everybody knows with certainty that Fed Powell's got our back and he's going to control inflation. But as that narrative changes and people are sick and tired of their spending power going down, they're sick and tired of the real value of their portfolio going down, seeking out a store of value asset, we see no other asset that can replace gold bullion. That's why if you look at the 1970s, even that brief period of inflation in the mid-2000s, you saw gold in the later part of the inflationary regime really respond. And that could happen independent of rates. So we would expect gold to rally significantly as we get later in the cycle. And the last thing would be income generating real assets. Think of things like infrastructure companies that can insulate, quickly pass along inflation to their customers while maintaining profit margins. Think of eventually REITs. You're getting higher yields now because of the adjustment in rates. Property values going up, yields off those properties eventually going up. Later cycle, those become more attractive. And those are the primary assets. So again, I'll say it. Resource assets, commodities, natural resource equities, financial, gold bullion, even gold equities, and the last are income generating real assets. Think of REITs and infrastructure and even MLPs.
The issue of commodities, what do you think about them with trend following? One of the things people have talked about a lot with commodities is the fact that they have these super cycles. And, there'll be really long periods where they do really well, and there'll be really long periods where they don't. Like, do you think there's any value in trying to use trend or something to determine the allocation to commodities at any given time?
I like trend following strategies for a very different reason than I like long only commodity strategies. So it kind of goes back to what I was saying in the beginning. I can see value in all strategies that work. Now, here's the thing, and you laid this out perfectly. Commodity cycles, they run these super cycles. They typically last, bull and bear markets typically last for 20 years. That's a very, very long cycle. We think that we're in the early stages of one coming off a very deep one, a very deep commodity bear market. And we think we're in the very early innings of what will be an extended bull market in commodities. Now, from an allocation perspective, I want to own commodities, especially because interest rates are higher, right? Keep in mind, in the last environment, you had collateral effectively earning zero. Now you're sitting there with commodity funds with positive roll yield, and you're also looking at your collateral earning 4 to 5%. So it's a very different environment than it was 10 years ago investing in commodities. And commodities do have these bull markets and bear markets. Now, the thing with something like a CTA or trend following commodity strategy, they're great as well because they're giving you differentiated returns and the potential to outperform in a bull and a bear market. Now, I'll emphasize potential because a lot can go wrong there. But I look at one as an alternative strategy, and I look at one as a core allocation, and I think that they both add value. But when I think about a diversified portfolio, I want to own a lot more of the diversified commodities because you're going to have a lot less implementation risk. And if you actually stay in this inflationary regime, which actually happens a lot more than people expect, then you're going to get a lot more protection than you would through a trend following strategy, in my opinion.
One of the questions you'll see from investors a lot in terms of inflation protecting assets is, on one hand, you could say, all right, I want to have exposure to these all the time because I don't know exactly what's going to happen with inflation. I don't know when it's going to spike. And then other people say, no, only when we see signs of inflation should I have an allocation to inflation protecting assets. So how do you think about that in terms of if people should have it across the market cycle or if it's something that they should try to time in some way?
Timing is such a difficult thing, and the graveyard is littered with bodies of people trying to do such. Here's the way that I think about it. I think this is a really simple way to think about it, and I think this is the right way to think about it. We went back and looked, and we wrote about this in our last commentary. If you go back and you look at the inflation since the inception of the CPI, you'll see that the high inflation, 4% or above, happened around 30% of the time. Inflation, 5% or above, happened around 22% of the time. There's 4 major economic regimes: high inflation, low inflation, high growth, and low growth. If an event happens around 30% of the time, by definition, it's not a tail risk. That is a very real risk that should be protected in your portfolio. So I think that people should have assets that can perform in high growth, low growth, high inflation, and low inflation. So I don't think people should be timing this. I think that they should have an allocation. But the allocation to resource assets should not be nearly as big as the allocation to both commodities and bonds. So when I think about a 60-40 portfolio that's absent of that, I think that that's wrong because it's denying an economic regime that has historically happened a lot and it's currently happening right now. So the way I think about it, I think the average investor should own around 15%, 15% to diversified real assets. That means if you're in a period of low inflation, you're going to do just fine because that 85% of your portfolios, it's ready to rock and roll. But when they're out of favor and your stocks and bonds are losing money at the same time, that 15% is going to come in handy.
Would you ever think about what sort of within your strategy, if you think there's going to be ultra high inflation, like weighting more towards things like commodities, which are probably the best inflation protection asset if you get really high inflation, like versus some other ones that maybe are better in moderate inflation? Is that something you would ever think about?
So I manage a strategy called the VanEck Inflation Allocation ETF. The ticker's RAAX, RAAX. And what we do is we invest in those key inflation fighting assets that I said up front: resource assets, income generating real assets, and financial assets. And then we bias the portfolio towards the assets that will lead the market higher. So we'll use momentum and we'll allow our winners to run up while keeping a very careful balance in the portfolio to make sure we're not overexposed to any one of those. So yeah, when you look at our portfolio, it's not a surprise that about half the portfolio, if not more, is in commodities and natural resource equities and very inflation sensitive assets. If you incorporate the gold exposure and the gold equity exposure, that's the core of the portfolio. So yes, we do that. But if we got into a period of extended low inflation, you're going to see a lot more REITs and infrastructure, real assets that can perform independent of the inflation cycle. So you're right. I don't think you should have static allocations, but I also don't think you should be flipping around between this asset and that asset based off of your economic forecasting ability, because if that's the case, people are going to find themselves in deep water.
Just one more thing I would ask before I hand it back to Justin. I would ask you more about gold, because gold was something in 2022 that was sort of a disappointment for a lot of people. Like a lot of people thought with the kind of inflation we had, gold would have done better than it did. And I'm just wondering, what do you think about like for the return profile of gold? I mean, I've had some people say it's really good in ultra high inflation and it's really good in deflation, and maybe it's not as good in the middle. Like it's sort of like a smile type thing. I mean, what do you think about the return profile of gold in terms of fighting inflation?
Gold has done nothing but disappoint people since high inflation has materialized, but I think their disappointment is mostly rooted in not understanding when gold works. I think it's driven from psychology, from the acceptance of high inflation as a real risk in people's portfolio and the need to protect against it. So I'll go back to what I said before. I think gold rallies. I think gold ends up being a top inflation fighting asset. We printed so much money, right? The US dollar has been around for over 230 years. We increased the money supply by over 42%. We've completely blown out the money supply. So if you want protection from the extreme devaluation of the fiat currencies, gold has ultimately been, and we think will be, that store of value asset. We don't see that changing. A lot of people thought, well, Bitcoin may be that. Obviously, we don't think that that's the case as well. We think Bitcoin can add value for a totally different reason, from its asymmetric risk return reward profile and exposure to interesting technology, but we don't see it replacing gold as a store of value asset.
Your point earlier that different points in our economic history have had different levels of inflation driven by different things. I'm just wondering, as you were sort of explaining that, I was thinking like one of the trends of deglobalization actually might be another thesis, another way to support the idea of higher inflation. I mean, if you have more companies moving back here, which is more expensive to produce stuff here than it is in China, obviously what happened with the supply chain issues during the beginning of the war, it's sort of like, to me, that would set up like a long-term tailwind for, potentially higher prices for longer.
We talk about exactly what you're saying all the time. You have a situation where we woke up in 2020 and we said, hold on a second. We exported our production for a long time, and it's been great because we drove deflation. China opened up, they were ready for business back in the 70s, 80s, and we just gave them all our production. And in return, we got really cheap goods, right? The price of flat screen TVs and everything else got cheaper and cheaper and cheaper, and it was a big party. And we were able to keep this disinflationary period for a long, long time. And then we woke up in 2020, we found out what happens, how super vulnerable our supply chains are, and how it's actually a national security issue. And now we're trying to bring that production back. The problem is you're bringing production back to one of the places that's the most expensive to produce goods and services. And you expect that not to drive inflation. Those disinflationary forces are now working in reverse. And that's what Volcker had at his back. And that's exactly what's working against Powell. So we can put that in the column of things that Volcker had going for him and things that Powell has going against him. I'm glad you brought that up. Thank you.
Would you say, and I kind of think I know the answer to this, but I'm interested from your perspective, because I'm guessing you're talking to a lot of advisors about this, but are investors generally underexposed to commodities? Like to your point about they did so horrible from like 2006 to like end of 2020 or whenever it was, for like a 15, 16 year period, commodities really had a bad, and I would imagine, a lot of investors, you could have just bought the standard 60-40 and done great. But obviously last year, commodities would have played an important role in helping, support someone's portfolio. So in general, do you think still investors in the market are under allocated to commodities?
You're hitting on something that we're stressing so hard with clients. There's something called conditioning. We're conditioned to think what happened yesterday is likely going to happen tomorrow. So we had this period, and it was truly remarkable. We had the longest period of low inflation, disinflation ever, which led to super low and falling interest rates, which gave us a great bull market in bonds and an even better bull market in growth stocks. So people are sitting here saying, I'm waiting for that to happen again. And they'll deny the bull market. It always takes a few years of a bull market in a different asset class for people to realize it's actually happening. They will deny it and deny it and deny it. Now, it's interesting. People will say, well, Dave, why would I buy real assets if I expect a recession? So my retort to that is you're thinking about the problem all wrong. Let me be more specific. If you took that mindset to stocks, you would say, well, Dave, why would I own any stocks if I expect a recession? Or Dave, why would I own any credit-based investments, bonds, if I expect a recession, right? Credit spreads will blow out, earnings will go down, stocks will be vulnerable, bonds will be vulnerable. But no one's talking about liquidating all their stocks and their bonds. At least I hope not. But they think about that when they talk about commodities or resource assets, because they don't view them as core allocations. Now, I'm not talking about everybody, but I'm talking about a lot of people. So if we want to have a conversation around what's the strategic allocation to real assets, I think it should be 15%. And we say, all right, well, I expect a recession. I want to take from 15 to 10. I think that's a fruitful conversation. That's warranted. But if we have a conversation around 5 to 0, now what we're talking about is people relying on their near-term expectations of continued disinflation. More specifically, we're talking about people taking their ability to forecast the economic activity and betting their nest egg on it. That's exactly what we're talking about. And in my opinion, that's quite frankly ludicrous. Forecasting is super, super hard. Betting your nest egg on it is ridiculous. So from our perspective, stay diversified, stay resilient to the different economic regimes, and that's the best way to have success over time.
To your point, I think, that could be, again, another strong tailwind for a lot of these assets if investors are in general underexposed. And if the cycles, we're more towards the beginning than we are towards the end, it's going to take time for investors to gravitate and allocate. So I think, that's an interesting opportunity for sure.
ESG investing compounded that problem. A lot of people by mandate can't own investments in commodities or companies that extract, let's say, traditional energy. So you've got entire segments of the investment population now, for the first time, that aren't accessing this. So we have constrained capital. Eventually, we think you're going to see a lot more upside in a lot of these investments. And as people appreciate the bull market as it goes on, you're going to see people finally reintroduce themselves to these assets.
You had a really interesting piece on your blog where you wrote about Microsoft and ExxonMobil, and you looked at their free cash flow yield during various economic regimes and how they the performance of, both of the companies sort of flip-flopped over time. So can you just explain what the piece was about?
Yes. So myself and another gentleman in the investment industry, he would frequently say, well, just buy Microsoft and go on vacation. Because if you were to do that, you look back, you would have returned multiples of the performance of the S&P 500 for the decade leading up to this. And if you'd have bought ExxonMobil for that decade, you would have been roughly flat, up a little bit. The free cash flow yields in a low growth environment were huge for one and terrible for the other. But if you expand out and you look at history and you go back beyond what people are accustomed to in the previous low inflation, disinflation, low interest rate environment, and you look, there was a period of time when Microsoft significantly outperformed, when ExxonMobil significantly outperformed Microsoft. I'm not growth managers. I heard value managers say this, and I've heard growth managers say this. I've heard growth managers say value is dead, and I've heard value managers say growth is dead. The reality is they work in cycles, and those cycles typically last 5 or 10 years. And I think we're likely going to be in a continued value environment that's going to benefit people that have exposure to commodities. And right now, the free cash flow yields for ExxonMobil are really high. And when you take really high free cash flow yields, historically, you've gotten above market returns from that. So the expectation would be you see continuation of that for some time. Eventually, probably in a year or two, people will start to recognize that and start to put money into these assets. From there, we think you're going to get significant price appreciation.
One of the concepts that I want to ask you about is how you take into account risk or a risk weighting into the strategy that you're using for the ETF. So how do you actually put that risk weighting into practice, and what do you look at?
Yeah, let's go back and talk about the inflation allocation ETF. So the ticker's RACs on that again, and really what's it doing, right? So let's just go back to the beginning. I'll talk about the risk weightings. 3 differentiated inflation fighting categories: resource assets, financial assets, income assets. So we know what they are because we've done tons of research on what are the best inflation hedges based off economic rationale and actually a track record of performance during a period of high inflation. So those are the assets we want to go with. But then you've got a question in your head. Well, all right, now I know what the assets are, but how do I weight those assets? A risk-weighted approach makes a lot of sense to us. We always want to be around and give people a diversified portfolio over time, right? Because the market can change and things can get very, very volatile, and your strategy can go out of favor really quickly. So we want to give people a really good experience. And a lot of people have had bad experiences generally with resource assets because of the high volatility. So what we're looking to do is maximize diversification by minimizing volatility. What we're doing is we're looking at the contribution of volatility. So how much these assets go up and down and how much they go up and down together to build the most diversified portfolio that we can. And we're constantly checking that to make sure each of these individual groupings and individually aren't contributing too much risk to the portfolio. Because if they are, it's probably a good time to reallocate some of that capital elsewhere. Because at the end of the day, we want people to have a good experience. And they're going to have a good experience if we can provide them strong performance in both up markets and down markets.
And by the way, that's so important to understand that, all investors have these biases and can have bad behavior, especially when a strategy is not working or if the downside volatility is too much. So the fact that you're doing that is really great because you're actually trying to get the end investor the best long-term returns within this asset class.
That's right. So what's a volatility level that people can tolerate? If the best way in our view to think about that is, well, the S&P 500 is the ultimate asset, right? Everybody owns that in some form or fashion, either directly or indirectly, or a return profile through an active manager that closely mimics that. And that's giving you a volatility profile of around 15 to 20%. So if we can bring the volatility profile of real assets from really high down to that palatable 15 to 20%, we think that that's a level of risk that most people have clearly been able to tolerate over time. And that's really our indirect goal when it comes to volatility management. And we do that through diversification.
This has been really great, Dave. I think this is a very important thing to be looking at, thinking about. I mean, we haven't been in a high inflationary regime for a long time in this country, but it's here now. And I think strategies like yours can certainly play a very important part in a long-term investor's sort of investment allocation. So you're doing great stuff.
Thank you so much. Thank you so much.
We like to end these podcasts with a standard closing question, and you can go anywhere you want with this, but based on your research and experience in the markets, if you could teach one lesson to your average investor, what would that be?
I'm going to approach this with the most important decision that they're going to make, which is asset allocation. Understand that economic environments change. Your four major categories: high inflation, low inflation, high growth, low growth. Build a stable asset allocation mix that could handle each of those economic regimes and stick to it. Don't be too tactical. Don't completely move in and out of asset classes. It's fine to adjust at the margin, but don't be too aggressive with that because we're talking about increasing the amount of time you have to work and what you could do with that money eventually, right? By making careless errors. And I've seen too many people over time be too aggressive with tactical shifts. So stay strategic, ride through volatility storms when they happen, and look at them more as opportunities as actually opposed to running for the doors and selling everything.
Good stuff. If people want to learn more about you, maybe follow your research, learn about the ETF, where can they go?
VanEck.com.
Nice and simple. Great. Thank you very much, Dave. We appreciate it.
Thank you.
This was awesome. Guys, thank you so much. It was a lot of fun.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment.